Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 4 growth companies to keep on your watch list for the upcoming trading week. And over the next few days, I'm expecting a lot of volatility in the market. We have a major vote coming from the House on some legislation that could impact the big tech companies, as well as a few key earnings reports from some of the strongest consumer brands in the world. And after last week's performance, where the Dow suffered its worst single 5-day performance since back in October of 2020, the major blue chip index lost more than 500 points in its worst slide in the past 8 months. So I'm expecting the volatility to continue over this upcoming week, which may lead to some excellent buying opportunities. But before we take a look at the companies I think will be affected over the next few days, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and we're going to focus on today the big tech companies as well as a few key brands who are releasing their latest earnings over the next few days. So what I think to be the most important event over this upcoming week is the vote on the new legislation that may break up the big tech companies. So later on this week, the House is voting on 2 main bills that will directly impact Amazon, Google, Facebook, Apple, and even Microsoft. And the 2 key bills are going to break up the platforms that compete with other businesses. So for example, Amazon, Google, and Facebook all created a platform that allow other businesses to sell and produce services. But what this bill is trying to do is break up the fact that these parent companies who operate the platform are also selling goods on that same platform and competing with the other companies. They're saying it's unfair that Amazon can list all the products from other suppliers, but also sell their own product in that list as well and promote theirs above the competition, and that these big tech giants are acting as monopolies. So what it's threatening to do is actually break up these big tech companies and force them to split into 2 or sell to some specific divisions that are key revenue drivers of the overall parent. So right now there's a lot of volatility within these big names because this could have a major impact on the entire big tech sector, and companies like Amazon, Google, Apple, and Facebook are at big risk of losing some key divisions of their overall company. And some big rumors include Apple's iMessage system may act as monopoly, Amazon and their Amazon Essential products are not going to do well, Google and different advertising products promoting their services above the competition is a big key threat to the company, and overall, a lot of things could go wrong with this big tech vote coming over this next week. So I think all the big giants in Apple, Amazon, Google, and Facebook are definitely worth taking a look at as a whole, because if they're volatile over the next few days, I think these companies are still going to grow long term. There may be some changes in their operations, but definitely worth taking a look at if we see further dips in their share price. And the one I want to talk about specifically is Amazon. So the company does trade right now for $3,486 per share. But of course, with fractional trading on pretty much every brokerage available right now, you can buy into this company for as little as $1. And on the 1-year chart, they are up 31%, but I think this performance looks somewhat misleading. If we take a look over the past year, from back at the beginning of September 2020, so around 9 months ago, the company reached $3,531 per share. And over the past 9 months, they have not surpassed that level, and they're still down around 1 to 2% from that high. So over the past 9 months, the company's been pretty much trading sideways for a big growth player. And why I included them in this week's video is because I am expecting a decline if this vote goes through and if we have some more, allegations against the company, but also because they're hosting the Amazon 2021 Prime Day. It begins on Monday, June 21st. And why I think Amazon is such a powerhouse is because they created their own consumer holiday. They created their own holiday for consumers to spend more and more money every single year on the Amazon platform. It's absolutely incredible that a company was able to make up an event like this and drive billions of dollars worth of sales onto their e-commerce website. So that takes place this week, which I think will have a positive benefit on the company, and it is a good time to buy the stock. But also, if we see a decline due to the vote from the House, I think will be another opportunity to buy this e-commerce giant who controls around 40 to 45% of the entire US e-commerce retail sales. And if we take a look, year after year, the company's performance has been nothing less than spectacular. Back in 2016, they generated $135 billion of total revenue. Fast forward to the trailing 12 months, that has grown to just over $419 billion, meaning they've tripled their total top line in only a 5-year span. A company as large as Amazon has gone from 135 to over $419 billion in sales during the past year, which is absolutely remarkable. And for many years, the company was not worried about profitability. They were just growing at a fast rate and expanding their total top line. But as of late, the company has shifted a focus to growing their profits, and we can see just around $26.9 billion of net income over the past year as well, which is a very strong sign. And even with all the risks of getting split up or having to sell out of a couple divisions, Amazon is still projected to grow very well over the long term, and we can see analysts are forecasting that over the next 5 years, a 38% annual expansion going forward each and every year. And currently, the stock trades for below $3,500, and that sits well below the 12-month expectation of over $4,200 per share, and it's currently rated as a strong buy, coming in at a 1.6. So although Amazon is at risk at losing a division or two from its platform, the overall company is still projected to grow at a massive rate year after year. And one thing that I want to share, I think this is a stretch, but there's rumors that if this new legislation goes through, Amazon Prime free shipping is a feature or a division of the company that may get impacted. The one driver of Amazon that keeps the entire company afloat, that really drives demand, is how fast they can get the products to your door. In some rumors, I'm not saying these are guaranteed whatsoever, these are just rumors on the internet, that if this legislation goes through and they're strict about it, the fact that Amazon and their logistics services may be a division that will be impacted and could actually hurt the free shipping options. So I don't know if that's going to happen. We don't know that much information just yet, but just something to keep in mind when evaluating Amazon at this current point in time. So overall, I think Amazon is definitely worth adding to a watch list over the next trading week. And now we're going to take a look at the second company I've included in this Sunday's episode. It is another big tech name, but it's not one of the main ones I think are going to be harshly impacted from the new legislation. When the Journal reported this new bill, there was 4 key big tech companies that were expected to have the major negative effects if this does go through, and that includes Google, Apple, Facebook, and Amazon. But you see the 5th big tech company that's not included as one of the ones that are going to get harshly impacted right away, Microsoft. The name was not mentioned in this article, and on many articles on the internet, Microsoft's name was left out. Although they are expecting some minor consequences if this bill goes through, nothing as dramatic as the other big 4 tech companies. So I've included them in this week's video because if they fall like all the other ones because of these new rumors, and if the market treats the entire tech sector as a whole and we see another 5 to 10% drop, Microsoft may be a company worth picking up some shares. If it falls, but we're not expecting as bad of a negative impact due to the legislation, it may be a great opportunity to buy the dip on some news that isn't going to hurt the company that much. So overall, Microsoft is the second big tech company we're going to go over in this week's episode. And now if we take a look at stock number 3, we're jumping away from big tech and into one of the leading consumer brands, and that is ticker NKE, which is Nike. They trade for $128 per share and have grown by 30% over the past 12 months. The company's a market cap at $202 billion, a dividend yield at only 0.86%, and a pretty high forward PE ratio, right around 41. So I have to admit, for a growth company, especially in the consumer sector, they are trading at a pretty high premium at this current point in time. But we can see over the past around 6 months to start 2021, from a high point at $147 per share, the company has fallen over 12% back down to the current level. So although they are still trading at a premium, if you believe in Nike long term, it may be a brand to take a look at. And currently, they report earnings on June 24th after market close. We have a revenue estimate at just over $11 billion, with earnings per share of 51 cents. And we can see that over the past 4 quarters, they missed once during the height of the pandemic, then have followed it with 3 major beats over the past few quarters. And then going forward, we're expecting some double-digit growth throughout their fiscal 2022. And for a company like Nike, throughout this pandemic, they transitioned away from their retail locations and had a big push into direct-to-consumer online sales that of course come with greater margins and greater profitability. So going forward, the company actually believes, and they came out with a statement saying they believe although their retail location is going to open and that will help the business grow, that their digital and online marketplace will remain a prominent player in the company's future expansion plans, and the higher margins are going to lead to greater innovation in their product line over the next few years. And currently, the company has been growing revenue year after year before the pullback in consumer spending due to the 2020 pandemic again. We can see in 2016, they had around $32 billion of total revenue, up to 34, 36, 39. And then of course, throughout the pandemic, we actually saw one of the highest savings rates in history of the United States. More consumers were saving money instead of spending it on luxury goods like a Nike product. And they did see a slight pullback in total revenue down to 37.4. But then over the trailing 12 months, we are seeing that it's coming back to over $38.5 billion of total revenue, which is a strong sign. And taking a look at the net income, the company did remain profitable, and throughout 2020, net income of around $2.5 billion, which has grown to $3.4 billion over the past year. So the company has been doing very well, continuing to expand over the long term, and we can see their gross margins have been pretty consistent over the past year as well. And taking a look, although the dividend is pretty tiny at less than 1%, it makes up a minimal 35% of their net income, and the 5-year dividend CAGR is at 11.5% per year. So though your starting yield is lower, and if you buy into a company like Nike on the week of their earnings, you're there for the long-term share price appreciation. But getting this growing dividend that's compounding rapidly year over year is a nice bonus to hold the company longer term, and their dividend growth streak currently sits at 19 years. And going forward, Wall Street does have some pretty strong predictions for the company. They're forecasting 40% growth each and every year for the next 5 years. And the current share price at $128 is below the 12-month expectation of $164. And the company is considered a buy, coming in at a 1.9. So they're the third stock we're going to take a look at in this episode, the big consumer brand that we all know and love. I'm sure many of the people watching this video today have a Nike product at home. It's a big part of our lives. They're a major player in the sports world. And I think going forward, not many companies will compete and take out Nike from the #1 market leadership position. So definitely a consumer brand to take a look at and have on a watch list over the next few days. And now we're going to transition into the fourth and final company we're going over in this episode, and its ticker JKS. Before we talk about this company, I'm going to be very clear, this is a speculative play. This is a risky play, has the potential for a lot of growth, but also has the potential to see some major losses. So keep that in mind. Remember, I'm not a financial advisor. Nothing we discuss in any video on the channel is financial advice. I just take a look at different companies that have different news events coming out over the next few days. And Jinko Solar is a Chinese solar panel manufacturer that reports earnings this week as well. They trade for just below $40 per share and have grown 151% over the past 12 months. They're trading with a forward PE ratio just below 13 and a market cap at $1.9 billion, with some major short interest above 19%. So of course, this is a risky player. I'm going to say that again, and I'm sure I will repeat myself a couple more times throughout this analysis to make it very clear that before you think about buying this company, you have to do your research because there are a lot of associated risks. So like we can see, the company did explode throughout 2020 as growth stocks took off, as the entire speculative market exploded, and as the solar industry in particular saw some massive growth, Jinko Solar absolutely expanded. And from their high point in October of 2020 at over $87 per share, from that level, they have now seen a major pullback of over 55%, back down to the $39 to $40 range. And currently, they're the world's leading solar panel manufacturer, shipping over 11.4 gigawatts of modules in 2018. And another risk is that this company is a Chinese brand, headquarters in Shanghai, China. So of course, all the Chinese companies on the market right now trading on American exchanges do come with a lot more associated risks. And of course, I included them in this week's episode because the company reports earnings pre-market on June 25th, and we have a revenue estimate at $1.18 billion with a loss per share of 1 cent. And although this company is a risky investment, although it's not one of the solid solar companies on the market, it is a Chinese brand which also adds some more risks. I included them in this week's video, not just because of their earnings, but if you want to take a risky gamble, not an investment, but a gamble into the solar space, and you want a company that's on a major pullback with the potential to grow, then I think this is definitely a name to take a look at. We can see over the long term, total revenue is picking up to around $5.38 billion over the past year. And one thing I like to see is this company's reporting positive net income each and every year for the past 5 years. Throughout many companies in the solar industry, even at this current point in time with the cost of solar going down, they're posting billions of dollars of losses year after year after year. But Jinko Solar has proven that over the past 5 years, they can grow revenue while maintaining profitability, which is a strong sign. So of the risky solar plays potential on the market right now, Jinko may be one to take a look at and do some research into, and of course speak with a qualified professional. And if we take a look going forward, analysts are forecasting 25% annual expansion for the next 5 years, which is a pretty strong sign that some analysts on Wall Street do think this company has the potential to grow over the longer term. So this was the fourth and final stock we're going to take a look at today. Overall, we took a look at 4 companies that I think will have a volatile week up ahead. I think the big tech companies in particular are going to have a very interesting week on the market. And as the Dow recovers or continues to fall from its worst single week since October 2020, many companies may start to trade at an attractive level. So definitely a few names to take on your watch list for the next few days. Thank you for watching this video to the end. We do this type of update every single Sunday to inform you of all the major events taking place over the next week. So please hit that like button, subscribe, and join the community, and I will see you in tomorrow's video.